I'm not like an avid watcher of the Ramsey Show, but I see a lot of clips online where you guys talk about mutual funds and investing in mutual funds. I was wondering, why do you recommend mutual funds over index funds?
Great question, man. How old are you?
21.
Lovely. And
I'm going to take a contrarian take here just off the jump, right? Because I'm a big hater of mutual funds. I'm way more on the index fund side.
Are you investing right now?
Yeah, I've been investing since I was 15.
Yeah.
Oh, my goodness.
Dude, that's amazing. Who taught you that?
My dad taught me a little bit.
My father.
And I read about it.
Nice.
Dude, that's awesome.
What have you been investing in for the past 6 years?
So I was doing like mostly index funds, but I like to play around, do some stock picks, but obviously not a big portion of my portfolio goes towards that.
Okay. He's already off the jump, a really disciplined investor, right? Started at 15, index funds, plays with a little bit of money, which is good, right? You should play with a little bit just to kind of learn, like I don't see anything wrong with taking a couple percentage points.
Are you working full time?
Yeah, I'm in marketing.
Nice. That's amazing.
Guys, got the drives. I'm in marketing, drives person.
Okay, and how much are you investing as a percentage of your gross household income?
Probably like 25, 30%.
Oh my goodness.
He is ahead of the pack, right? The average person's putting 0. And then the ones who do invest, maybe we're 6%. I think I'm 7, 8, somewhere in that range. 30's huge.
Okay. So you're going to be a multimillionaire regardless of this conversation that happens next. Can we agree on that?
Yeah.
Okay.
Where do you live, Matt?
Right outside of Charlotte.
No. Like, do you have your own house, your own apartment? You living with mom? Where are you living?
No, I still live with my mom at home.
Okay. All right.
Cool. How much do you...
There's why he can put a 30% chunk, right? He probably has no cost of living. Mom's doing groceries, mom's cooking, and he's out there working, and he's taking advantage of it, right? You can't hate him for that.
make a year?
Yeah. 80 to 90.
Oh my goodness, dude, you're crushing it. So we're talking, you're investing like $18,000 a year.
Yeah.
And you've got a 401k through your employer?
No, I use a Roth IRA.
Okay, so what happens after you max that out?
I just put in a regular brokerage.
Okay, great. So let's talk about index funds versus mutual funds. And for the listener's sake, if they're like, what are these goober nerds talking about? Index funds are basically passively managed mutual funds. So still a giant group of stocks, but it's tracking an index, basically a set list of companies, whereas the mutual funds are actively managed.
And you can buy like an idea, right? You want to buy energy stocks, you want to buy healthcare, you want to buy whatever. There's an index to track any sort of idea or type of investment you want to do.
Managed has an investment manager that is selecting the funds that make the list.
Let's go even simpler for guys like me. When you say indexed, they're indexed and they're passively managed.
So index, there's no one running the show. It's just a set list
And
of
so they pick. I'm making these
the
up. They
S&P
pick
500. There's
okay.
500 companies, the largest U.S. companies.
And if they go up, then the index fund goes up. And if they just all go down, then the index fund kind of goes down. And over time, we hope these companies just keep getting bigger and growing.
There's also requirements to get into the index, right? You have to have a certain company size, certain income, trade above a certain value. There's a committee that welcomes you in and says you can or you can't. And they also chop companies and they don't trade at a certain level.
And then can companies fall off the S&P 500 and
Yes.
new ones pop in?
Yes.
So the whole thing should be just going up over time.
Correct.
Exactly.
And so index funds means nobody's driving. It's just following whatever.
It's the autonomous vehicle of the investing world.
Ooh,
You like that?
You just ruined it
John,
for
like,
people.
I know.
Like S&P 500 is like, I'm betting on the U.S. economy, right? That's what it really is a bet on. Or, the QQQ, I'm betting on U.S. tech stocks. That's what it's a bet on, right? The index allows you just to bet on a generic trend.
There we go.
Excellent. Okay.
So is that a
thank you for
good
that.
summary, Matt? Because you know about this stuff just as much as we do.
Yeah, and
Okay.
one thing that's sort of important to like note is that mutual funds sort of have built-in fees, right?
Correct.
You know what I mean?
Correct.
Like there's built-in fees.
There's an investment manager. There's people to pay because this is their job to run
exactly.
these. Exactly.
Yeah.
So they do have fees. The perks of the index funds, as you know, diversification, which mutual funds have, low expense ratios, which index funds have, and predictability. And, every investing
Right.
rose has its thorn. For starters, your index funds won't beat the market because it represents the market. Does that make sense? So you'll settle for the average of the market.
Yeah.
You can never beat it. The goal of the mutual fund is that investment manager is hand selecting funds based on tons and tons of research that they're doing every day, day in and day out, in order to attempt to beat it. So let's say the market does 10%. Well, the goal of the mutual fund is to do 12% or 14%. Now, as we know, they won't hit that goal every year. We don't have a crystal ball.
See, but this is a bad take because I just put on ChatGPT on the other screen I have 21% of mutual funds beat the S&P 500. So 8 out of 10 don't. So you have an 80% chance that you will earn below the average rate, which is the S&P 500. So if you're choosing between the two, it's like, why would you not take the one that's 80% more likely to return more and the other one that's 80% less likely to return more? It makes no sense.
We can agree on that.
Do you look for specifics in a mutual fund to try to hit those funds? Because I know 80% of mutual funds don't beat the market.
No, that's actually factually incorrect.
Let's see what he said.
Morningstar did this article, and they said nearly 57% of mutual funds, these active U.S. equity funds, they beat the average index fund peer over the 12 months through June 2023.
Yeah, that's a terrible take because if we extend it to a 10 and 15-year period, it's like, oh, okay, so for this little period of time, you beat it. But over 10 or 15 years, 80 to 90% do not beat it. It's like realistically, then 80 to 90% do not beat it, right? That's like a manipulation of the data at that point there.
So that means 6 out of 10 mutual funds beat the index.
For a tiny period of time.
Wait, over how long?
Over a 12-month
1
period.
year.
They looked at, here's what mutual funds did, here's what the peer index fund did. 6 out of 10 beat the index fund.
Yeah, weak.
Right, but why are you looking at a 12-month period versus decades?
This kid's so smart. This is why he's making more money. He's making.
You can look at decades, and it's going to change depending on the decade you look at.
Ooh, Matt.
And the truth is, there's going to be mutual funds that don't beat the index, and there's going to be years the index beats the mutual funds. And so the goal here is to slightly beat the copycat of the stock market.
No, I disagree. The goal is not to slightly beat the copycat. The goal is to have a steady return over time that you can count on, right? I would say it's like if 80% are not beating the copycat over a 10 or 15-year period, then that's a terrible advice to say, oh, you put it into that 80%. When you don't know which ones, you're 8 out of 10. If you have 10 marbles to choose from and 8 out of them are gonna return below, then it's like odds are you're not gonna make more money over a 10 or 15-year period.
Is the index fund. And so the index funds also do have a fee. You'll see it listed as a 12B1 fee. And so that kind of makes up for the fact the mutual fund fees there.
So if we put this all together, right, 80% go below, and then they also have a higher fee. So this is like, yeah, come on,
So it's not exactly free. And here's the thing. We're not anti-index funds. There's a time and place. In fact, Dave Ramsey invests in index funds outside of retirement. You have that taxable brokerage account, right?
Yeah.
Dave would say index funds are the smart play there because of the low turnover. They're not moving things around as much.
So the thing with the mutual funds for retirement is like if you put a target day retirement fund of like 80, right? You want to retire at 80. As you get closer to that day, it starts putting in the wider percentage of the index fund, of the mutual fund, into more safer things like bonds and other things. I think that's what he's going to hit at after here.
Which makes the fees less. But in retirement, you're not having to pay those fees because you're not worried about turnover because this is a long-term play. And therefore, he invests in mutual funds for his retirement accounts, index funds outside of retirement. So there's a time and place for both.
What do you look for in a mutual fund, though?
Well, there's a lot of pieces of it, including, rate of return, the expense ratio, what the fund is made up of, who the fund manager is. Have they switched the investment team recently?
So work. Basically, we have to do work, right? You're better off in the index fund. He's making the case. By making the case for mutual funds, he's actually making the case for index funds.
If it's been doing great for 30 years and all of a sudden they switch the crew, well, that's something you want to look out for because things might change.
Right. So I got to be...
And we actually covered this in depth.
I got to be with my periscope eye on the ship the whole time. Like, why would I want to do that when I can just have an index fund that's lower fees and historically has performed better? Makes no sense.
In our Investing Essentials live stream, and it's not currently available, but just for you, I'm going to send you a link to watch that for free. How's that sound?
They're trying to sell us stuff.
Good, but isn't that sort of inevitable? I mean, if a mutual fund has a 30-year history with one manager, and I'm 21 and I want to invest for another 30 years, isn't there pretty much a guarantee that the fund manager is going to change, the fund management 2015.
Dude, I said this kid was dry, but boy, is he analytical. I mean, he's pierced through whatever this other guy that he's responding to on the Dave Ramsey show. Just cut right through him multiple times with just very simple questions. The fact that the question is delivered so simplistically, it doesn't allow you to talk around the subject. Like, well, if they don't beat it over 80% of the time, why would you invest in it? Or you just looked at one period for 12 months. Why not look at a 15-year period? It's like, he had no answers to these. Same with this one right now, too.
Sure, over time, things may change, but what you're looking for is that longer term track record. And so we're not going to choose a fund that's been around for a year. We prefer the one that has a track record of 10 or 15 that's had the same team with the same record of success.
But dude, that's like saying I don't want to root for the Yankees or the Astros because they're going to have different players in a few years. The goal is
no, but what we're saying is we could just buy the All-Star team. Why would we want to buy the Yankees or the Astros or one of those when we can just get the All-Star team every year?
Hope that they have guiding principles and they have the same desire to win and they have the same integrity over time. Some teams are better at integrity than others with the teams I just labeled. I know Kelly's looking at me, not
Kelly's upset,
but you see what I'm saying? Like, yeah, the fund manager is going to roll over, but it will change over time.
Matt, here's the deal. We can argue all day and I can tell you like this, but you can be a multimillionaire just from your index funds. You don't have to ever touch a mutual fund if you don't want, or going to still be friends. You're doing great. The key is...
Yeah, the summary of this video is the kid's doing great. He is crushing it. I still think he's better off with index funds. There's just a hard argument for the mutual funds. Maybe the idea, though, that like you yourself don't have to convert your portfolio to a greater level of risk. Like the mutual fund will kind of manage that over time. But I don't know, man. I'm S&P 500 all the way. Unless something changes in the economy. It's like if we just look at the S&P 500 chart and know that 80% of mutual funds cannot beat the S&P 500, then where is the argument relying upon to put it into the mutual fund? So yeah, I'll leave you guys with that. Thank you for watching.